just to put it in some perspective, in Atlantic Canada, just talking about the Atlantic region, there's about 80,000 small to medium-sized enterprises, SMEs, about 80,000 across Atlantic Canada.
Thank you for listening to the Interesting People You Meet podcast. This podcast is sponsored by Newground Financial. Newground Financial is a full-service investment and insurance brokerage firm that specializes in employee benefit plans, corporate insurance, and retirement planning. Newground Financial serves the provinces of Nova Scotia, New Brunswick, PEI, Ontario, and Alberta. Find out more at newgroundfinancial.com. Thank you for liking, sharing, and commenting on the Interesting People You Meet podcast across all of your favorite listening platforms, including Apple Podcasts, Spotify, and YouTube. By doing so, you are ensuring that more great people just like you have the opportunity to hear from our guests. Thank you, and enjoy the show. So welcome to episode 19 of the Interesting People You Meet. We are joined today with our guest, Jeff Mackenzie, all the way from PEI. Jeff is a partner at the firm called Confederation M A, and we're very glad to have you here today, Jeff.
Well, thanks a lot for having me, guys. Appreciate the opportunity.
Awesome. So, Jeff, why don't you tell our audience a little bit about your story, how you got to where you are today, and what you do on a daily basis to help business owners.
Sure. Yeah. So I'm a partner with a firm called Confederation M A, based in little old Charlottetown, Prince Edward Island. I guess first and foremost, my main job is trying to be a husband and a father to two little girls. I'm in the 2 under 2 stage, so not sure if you can edit this in the podcast, but these black lines underneath my eyes from lack of sleep sometimes. So aside from that, though, yeah, I joined a firm about 7 years ago called Confederation M A, and been a partner since 2017, so about 5 years. And essentially, we're a low to mid market mergers and acquisitions firm, primarily based in Atlantic Canada. Although earlier this year we did open up an office in Ottawa, which is our first venture outside of Atlantic Canada. But we're still a relatively small team. We have about 10 people scattered amongst 4 different provinces. We have an office here in Charlottetown, which we would consider our head office, where I am, an office in Nova Scotia, New Brunswick, and now in Ottawa as well. So in the low to mid market space, just to roughly define that, we're generally working with business owners below $50 million as a rough range, and really as small as $1 million company. So anywhere kind of between $1 to $50 million in terms of sales value is where we typically see, and you know, we're helping entrepreneurs for the most part sell their businesses when it comes time to retire, or they're just looking to move on to other opportunities. So that would be the main part of what we do. We also help with business owners looking to buy or grow their businesses as well. So we might be representing somebody who wants to go and approach a business and help them through that process. So that's kind of in a nutshell what we're up to over here, and how I spend my days.
Awesome. That's great. Well, talk about being in the right business at the right time. In our world, we help with succession planning and planning for business owners, both sellers, buyers, and those that are on the fence. Clearly, there's a tsunami of change happening, and there has been, and I think it's going to get even bigger here in the next couple of years. And you came highly requested with your skills and expertise from a lot of our listeners. So for those of you who requested it, Jeff's here. You're welcome. And and yeah, so you know, in the next few years, you know, I see a big change happening, and I think it's already happening clearly with the boomers moving out, transferring businesses to family members or others. So, you know, do you have a rough idea with forecasting and whatnot here in Atlantic Canada, perhaps as wide as the whole country, what that looks like from your end? You know, how many businesses are actually going to change hands here in the next few years?
Yeah, it's I'm taking out a crystal ball a bit, like everyone else tries to do, and I think the short answer is there's going to be a lot. Like you say, Nick, there's a tsunami of activity coming, and just to put it in some perspective, in Atlantic Canada, just talking about the Atlantic region, there's about 80,000 small to medium-sized enterprises, SMEs, about 80,000 across Atlantic Canada. And in some recent surveys that were done, I think it was by BDC, one of the questions they asked business owners, small to medium-sized business owners in that survey were, when do you plan to exit your business? And this is probably a year or two old now, so a little bit dated, but I think the data is still interesting to look at, is over 70% said they plan to exit in the next 10 years, and a lot in the next 5 years. So just to do the math on that stat alone, you have 80,000 SMEs and over 70% looking to exit by, let's say, 2030. You have over 50,000 businesses that are planning on exiting in one way or the other in the next number of years. So just a massive amount of activity, and what is driving it? Well, I think multiple factors, but the obvious one is we have an aging population here, and we have a lot of business owners that would be in the baby boomer category of 60 up and approaching retirement. And there's a whole bunch of different reasons why people might look to sell, but the number one is still retirement. So yeah, there's certainly going to be a lot of businesses and activity hit the market over the next number of years, no doubt.
Okay. And as those business owners are considering getting out, some of the questions that we help clients figure out is, what is the actual value of their business? Because sometimes they don't know that, and they have to do a bit of planning before they go down the road to make things look right. So I'm just curious, in your experience in dealing with business owners, how many actually have a written succession plan? And part B to that question is, how many actually know what the value of their business is if they were to, sell it today?
Yeah, good question, Nick. On the planning piece, part A of that question, I believe it was the same survey actually that they talked about that topic too, and a very small percentage had any sort of plan, whether it was an informal plan or a formal plan to sell their business. I believe the stat is under 20%, so less than 1 in 5 business owners actually have any sort of plan to sell their business. And it doesn't have to be, the question wasn't even a well thought out plan. It's just any sort of plan of whether you might hire an advisor or, do it yourself, or, even turn your mind. So more or less 4 in 5 business owners sort of winging it in the preparation stages leading up to sale, which is a bit concerning, as preparation is key to the success in the process. But it's also, an opportunity. And you mentioned, Nick, I know you and Nathan, get involved in helping your clients in that lead up process to sale. And in our business, we try to help clients do that as best as possible as well, to get ready for sale. On part B of the question on valuing a business, it's does the average business owner have a great idea of how their business is valued? In my experience, no, probably not. They have maybe some rough idea just based on what they've heard in the industry of what other competitors might have sold for, and they might have an understanding of what their asset base is worth if it's a business that has, for example, real estate and equipment and machinery and that sort of tangible stuff. What's trickier is the intangible component and how much goodwill might be valued as in a business that somebody's willing to pay for. So, certainly that's something we're doing day in and day out, is helping business owners understand if they're to take their business to market, what value expectations they might be looking at, how is a buyer going to view their business, what sort of risk factors might play into that. So, happy to speak, more to that or dive into.
Yeah, no, hey, let's go. Let's go down that road. So like you touched on Goodwill. So, for the listeners who may or may not even know what that is, or if they think they know what it is, like, how do you define that a little bit? So can we spend a bit of time on Goodwill and how you define that as an asset and what values generally look like there, or perhaps for the seller, how to make it look more attractive to increase that multiple, really?
Yeah, 100%. So Goodwill and valuing that intangible asset, of a business is a tricky part, and why professional advisors like ourselves are brought into the mix oftentimes to help people understand that better. So, in a nutshell, if you consider how most businesses would be valued, it's often a function of how much earnings they're producing and what multiple of that earnings might somebody be willing to pay for the business. And it all comes down to risk versus reward. So it's just like anywhere else you plan to put your money. So if you have $1 million to invest, you could plunk that into a GIC, or you could plunk it in the stock market, you could invest in real estate, or you can buy an active business. And an active business is on typically the riskier end of the spectrum versus some of those other options. So as the level of risk increases in the business, generally the lower multiple that's willing to be paid. There's more risk on it. Your dollars aren't quite as certain as plunking them into a government bond or something like that. So that influences the multiple that's paid. And your earnings times whatever that multiple might be is essentially how it's an oversimplified way of explaining it, but it's ultimately what the business will be valued at. So let's just say hypothetically a business is making $500,000 in earnings, or EBITDA, which is earnings before your interest, taxes, depreciation, kind of a common metric that's used in the industry. And it's valued on a 4 times basis. So 500,000 earnings times 4, it's a $2 million business. Well, if that business only has $1 million in hard assets, that tangible stuff, machinery, inventory, buildings, then the discrepancy between the tangible and the total value is the intangible piece. That's the goodwill piece. So in that example, you might have $1 million in tangible assets and $1 million in goodwill to get to the $2 million valuation. So it can be a bit of a complicated road to get there, because there's lots of different considerations that have to be taken into account. There's some metrics that you see used in the industry, and it can be dangerous to use some generalization sometimes when people talk about, 2 times earnings, count that as your goodwill, 3 times earnings, count that as your goodwill. Yeah, sometimes those might make sense as a rough rule of thumb, or just put your finger up in the air and see where you might fall. But there's businesses are so case by case, and it's not like selling a piece of real estate. So that's why it's important to really get somebody who can navigate you through your financials and understand how a buyer might perceive those different risk factors to understand what multiple might be appropriate in your business.
Makes sense. Mm-hmm. And for that business owner, I think ultimately if you're selling, it's only worth what someone's going to pay for it. And it's, so as you enter into these negotiations, both assisting the buyer and the seller, not on the same contract, but in different situations.
Yeah, the tougher. Just to add a point to that, Nick, you raise a good point. Is we're in an environment I think everybody knows and sees what interest rates are doing in the market, and capital is more costly now than it was a year ago, for sure. So the other factor in terms of it's only worth what somebody's willing to pay for it is it's only worth what can be appropriately financed as well. There's not, in our experience, there's not a lot of buyers that are just going to cut you a check for the full value of your business out of their checking account and walk away. It's people go to the bank and they want to finance their deals, and they're probably chipping in some of their own money, but also looking to take on some debt to buy that. So the other factor we'd often look at as part of valuing a business is understanding how a business is going to be financed, what the cost of principal and interest payments are going to be, and can the business appropriately cash flow enough to be able to cover its principal and interest payments and still return a reasonable return on investment for somebody. And if you run the numbers and the answer is no, then the price is too high. That just can't service that level of debt appropriately. So that's also a factor you have to take into account. Is just you might hear stories about people paying 6, 7, 8 times on a business, but on your specific business, if you don't have the earnings to be able to support that on a debt basis, then you have to recheck your pricing expectations.
Right. So maybe a stupid question here, but you're quite knowledgeable on this process. So at what level does someone in your position get involved in those conversations, and when and if visits? Are you negotiating simply with the business owner, or the information they bring from their accountants and lawyers, or at what point did those kind of three things come together? And where does your expertise stop? Because it's interesting. I'm learning a lot from what you're saying already. So
yeah. So those types of conversations are often, I guess the quick answer is the earlier the better you start to understand some of those things, the better off you're going to be, the more time you have to prepare. So when we get involved with a client, ideal situation, they're actually, 2 or 3 years away from selling sometimes, because they want to check in, see where they're at, see where they might have strengths or weaknesses, see where their value is, be able to identify what some of those weaknesses or areas of improvement are, and then, work towards getting prepared for sale. I realize not all business owners may have that luxury of having, a few years to get prepared, or they might just reach a point and say, you know what, I'm tired now. I want out. I've hit the 65 mark. I want out in the next year or two. So it varies, but that's often a first step in our process, is to have that conversation with business owners. We take a look at kind of a couple different aspects. We take a look at the quantitative side of it, which is just how have your financial statements looked over the last number of years. Let's talk through that, understand your cash flows, your balance sheet, your assets. What are those intangibles, or, cash flow history. And then on the qualitative side is understanding more of a risk profile of the business. So, how much of your revenue is tied to a few key customers versus many different customers, or how sticky are those customers? So, is it recurring revenue that's happening year over year, subscription-based stuff, or is it one-time project-based, where you're always chasing that next sale? So kind of a mix of those two we have to understand before we can really evaluate what the value of a business is and what the risk profile of a business is. So that's kind of the first time we get involved in that. And then really as we work through the process with the business owner to sell their business, that's a conversation we're consistently having and looking at when it comes time to negotiating an offer and accepting an offer, is looking at how does this offer match up with value expectations, and offers aren't as simple as just saying I'm going to pay you X dollars for your business and that's it. There's often a lot more to an offer. It could be holdbacks or owner involvement in terms of still remaining involved in ownership or not ownership, and different things that you have to take into account. So it's often not just a pure apples to apples, and we have to weed that out a bit. So starts at the start, but that's really something we're looking at throughout the whole process.
Okay.
That kind of leads into, oh, sorry, Nick. I was just going to say that kind of leads into what I was thinking. You just mentioned what kind of happens if a business owner wants to retain ownership. And give us some scenarios of what if a business owner doesn't want to leave the business altogether and he just wants to sell it, get out, but still work there and kind of maintain that role that they had originally? And what kind of situations can come up from that?
Yeah, it's rare. It's more rare, I would say, that somebody sells 100% equity and then wants to stay on. It does happen. We've had scenarios where that's happened, and it's happened, and the owner's been completely content. But owners generally don't tend to make the best employees afterwards. If you've been your own boss for a while, it's tough to shift mindsets, and all of a sudden you're being bossed around by somebody else. So owners often, they recognize that. So if they're staying involved, might be for a period of time in the same type of role, but with a set transition period where there's an understanding there's going to be a handoff of the baton to the new owners after a period of time. So transition periods can take all different types of shapes and forms, but what we're most often used to seeing is at closing, the owner doesn't immediately sail off into the retirement sunset. There's a period of time that they stay there to support the old owners and make sure there's a smooth transition. And that can be really important for, introducing the new owner to key customers, for example, and making sure the relationship with employees is smooth. So oftentimes, that period could be 3 months, 6 months, a year, most often less than a year, where there's this transition period where the owner has sold their business, but they're staying on in some capacity, whether it's full-time or part-time or as a consultant, to help support the transition process. So that's very common. It's also, we've done lots of transactions lately where the owner might be asked to stay on in an actual ownership and equity position. So where somebody is buying 80 or 90% of a business, for example, and they want the owners to stay on or roll some equity back into the new company that's purchasing. So there's all sorts of different, and it's case by case based on what the owner's retirement goals and exit plans are. But oftentimes, there is some sort of transition period that's negotiated through a purchase.
Okay, and in the same breath, is it the same scenario for like a key person that's working there? Are there any sort of guarantees that the buyer gets with this key person, like how long that they have to stay for, kind of what their new role is? What does that look like?
Yeah, it's now as the owner of the business, as the owner of the or the selling owner, you can only sort of speak for yourself. So you can negotiate a transition agreement for yourself, and oftentimes the buyer will look for some certainties from you as a past owner. For example, they might want a non-competition agreement that says you're not going to go down the road and start a competing business to me tomorrow. They might look for non-solicitation, for example, that you can't go out and poach employees or poach customers. So as an owner, you can speak to your own agreement, but you can't guarantee what some of your employees are going to do or speak for them. So ultimately, that question on key people comes down to the new owner negotiating with those key employees to stay on, and that is fairly common that there is a number 2, number 3 person key management that it's very important that they stay on with the transaction. So new owners will often look to negotiate a new employment agreement. Oftentimes it's actually a great opportunity for senior people, because new ownership often want them to step up and maybe take a promotion or step up into a new role with more responsibility. So that's quite common that you see new sort of agreements being negotiated, but that's often not done until just post-sale with some of those key employees, unless the employees are brought into the loop earlier on, pre-sale, and that negotiation happens too, which can happen as well.
Got it. Okay.
Can you outline, Jeff, some of the so say I'm either intending to buy or sell my business. What is that? Maybe I know it's probably a very detailed, long process, but if you could kind of go like maybe step by step. So is there like a letter of intent? Like what is that? Okay, I'm getting out, or okay, I want to buy it. Like, what do I need to do to engage the seller or buyer on either side?
Yeah. So I'll take us up to the 30,000 foot.
Yeah, thank you.
Just kind of going through the steps, but
perfect.
So the first step is often to get what we call pricing analysis or evaluation done up front, so you have an understanding of what your business is worth, what it's valued at. That would often be our step one in the process, to make sure we're more or less aligned with a client before we go down the road of a process that your expectations are reasonable. We think there's a reasonable shot at getting you what you need to retire and sell. From there, when we enter an engagement with a client to sell, we would put together an information package about the business, which kind of outlines all the ins and outs that a buyer may need to know about a business to make a qualified offer. So financials are, of course, an important component of that, but also understanding the bit of a love story about the business. So how did it get started? What's the history? How did it grow? It's passed along generations, all that good stuff. You want to know about their customers, their supply chain, their employees, et cetera, et cetera, et cetera. So we put together that package, and in the industry, it's it's commonly called, and we call it a confidential information memorandum, or a CIM for short. So that package is what a group like us would put together, and we'd go into market to find buyers. Now, it's a bit, you feel like in the M&A world sometimes it's like this cloak and dagger, behind the scenes, secretive process, because we don't have the luxury of, in the real estate world, you can just, put it out to the public and put a sign out front. In the business world, I'm sure any business owners listening could appreciate this. It could be really damaging if your employees find out you're looking to sell, or your customers find out you're looking to sell. So confidentiality has to be number one through the process, and we take a lot of steps to make sure that word doesn't get out, that you're planning on selling. So once we have kind of step 2 done of putting together that information package, and step 3 going out to the market, we would come up with a strategy for what kind of prospects we should be going out to. So are we looking for strategic buyers? Are we looking for financial type buyers, investors? Based on what the business owner is looking to do, are we looking for somebody to buy 100% of the business or 50% of the business, invest in it to grow, or what's the goal of this transaction? And we would do that all on a confidential basis, and really before disclosing any information to anybody, we would always get non-disclosure agreements, confidentiality agreements signed off on. So, to reinforce the importance of not leaking any information. So after that stage, if it's on the market, then the hope is of course that there's some interest in your business and people put forward offers. So from there, it's the next step would be receiving offers on the business. So receiving can be called different things, but a letter of intent or an LOI is kind of a common term, or a memorandum of understanding, for example. So that document really outlines the high-level terms of what a purchase could look like. From there, if you do find an appropriate offer and you say, yeah, this is the party that I want to go to the dance with, and we've negotiated a successful offer, then you move into the due diligence stage. So due diligence can be a bit painful and exhausting, to be honest. That it's really a business owner, stripping down and getting the business naked, showing all your ins and outs to teams of lawyers and banks and business owner. But it's a time where the business owner's investigating, everything they can about, or the buyer's investigating everything they can about the business to make sure there's no skeletons in the closet. And at the same time, some of the other professional teams like lawyers are drafting up the purchase agreements, and your accountant might be helping with any pre-sale structuring items, for example. The banks are working with the buyer on putting together the financing. So there's a lot of pieces that would be happening during that phase to get ready for sale. And then, hopefully if we can navigate down that bumpy journey of due diligence, we get to a closing period and effectively close it. There's a little bit after closing too of possibly some holdbacks or adjustments and things like that need to be dealt with. But, the majority of the work from start to finish, that's kind of how it flows. Awesome. So maybe a bit of a longer answer than anticipated on the process, but that's kind of the key stage gates of how it all flows.
Perfect. And, I've been involved in some acquisitions and sales, and I'm just curious. One of the questions I usually hear up front from the accounting firms is it a share or asset sale? Can you dive into that a little bit, or?
Yeah, sure. So we share and asset sale are the two common structures of how a business would be sold. Asset sales, the easy one to get your head around. It's just like any real estate transaction would be an asset sale. You're buying the assets of the business. Most of what we see is actually, although asset sales are common in the business world too, but we would see much more share sales than asset sales, which is essentially that you're buying the business as a going concern. You're buying the shares of the company. The company legally is a standalone entity, so you're taking over that entity. And with that, you're inheriting the corporate history of that company. And that one of the disadvantages of a share sale is if there's a for example, a lawsuit that's kind of trailing on, and then you're inheriting those sort of liabilities that come with the company. But you're buying the business as a going concern. So we do see, in addition to share and asset, there's kind of a third class as well, I'll say, which is a hybrid transaction, which is basically just a mix of buying the shares and the assets. So in the case that, let's say there's a business with a piece of real estate or a building, it might be an advantageous structure to buy the property as an asset sale for the buyer and to buy the operating company that operates within the real estate as a share sale. So you can see some hybrids as well. And a lot of it comes down to tax planning advantages. Sellers generally, what you hear in the market is sellers like share sales and buyers like asset sales. And to not go into too many details, but sellers like share sales for the main reason is because there's something called a capital gains exemption here in Canada, right, that you guys know well about, but buyers have a lifetime capital gains exemption that on a share sale, they can protect some of the proceeds from tax with that exemption. So it's a much more tax favorable structure for them. The reason buyers may not like share sales much is because of what I mentioned earlier about the corporate history following, some of the liabilities, tracing on. And there's things that can be done in the legal agreement to protect the buyer against some of those things by the seller making representations and warranties that say, there's no environmental issues, there's no blah, blah, blah. So there's things that can be done to mitigate the risk for sure. Another reason buyers like asset sales is on a tax planning reason is because if there is real estate involved, for example, and that real estate was purchased or built 20 years ago, well, what has that real estate done over the last 20 years? It's gone way up in value. And if you purchase that business that includes this piece of real estate as an asset sale, you're able to bump up the value of the assets upon purchase to the fair market value, which allows you to reset your depreciation on it. So maybe getting a little too, again, in the weeds here, but if you have more depreciation on your income statement as a bigger expense, it's a non-cash flow expense, but it's going to help you save on some tax dollars. So from a buyer, it can be an advantageous tax saving strategy as well on an asset sale. So it's always a point of negotiation of, we see times when somebody says, here's a two-part offer. If you want to sell the shares, we'll offer X dollars. If you want to sell the assets, we'll pay you more. We'll pay you Y dollars. And it's up to the sellers to decide based on what the tax differences are.
Right. And there is some further on that depreciation, and maybe we're getting way too in the weeds here, but
let's do it.
If something was depreciated by the previous owner, is it not? It's not advantageous for the buyer because it's kind of gone, right? We lose that option. Is it? And maybe you just said that, and I totally went over my head. But do you know what I'm trying to say there? Or am I just not making any sense?
Yeah, say that again. So if you're saying if the building's been completely depreciated,
right. Yeah, and someone took advantage of that, and now I'm purchasing it. Well, I can't do that again, right?
Well, yeah, you. If I understand your question correctly, so if the real estate has appreciated and there's essentially a gain on that real estate,
right?
The disadvantage for the seller on an asset sale, to come back to that for a second, is there's been a cap. That's what's called a capital gain. There's a gain that's been realized on that asset, so you're getting taxed fairly heavily on that gain in the case of an asset sale. But for the buyer of the business, that gain can be advantageous to you because you're buying a more valuable asset, and now let's just say a building depreciates at 4%. Well, the old owner was depreciating a $1 million building at 4%. You're depreciating a $2 million at 4%. That's going to save you on taxes by lowering your income on paper. So, it's always just kind of really a mathematical exercise of looking at, how much tax dollars will this make on an annual basis for the for the buyer, and is that enough to offset the tax savings that a seller might realize from selling the shares at a capital gain? And oftentimes, unless the government changes the capital gains rates, there's quite an advantage there of using your lifetime capital gains. So that's the reason we see a lot of sellers opting for that route, even if it means they have to decrease their price a little bit,
right?
Structure it so appropriately that advantageous for them.
Got it. And for the listeners, again, here's a little infomercial or disclaimer, should I say? We're not tax specialists here,
neither am I.
Speak to your lawyer and tax accountant. This is a general conversation and educational information. But the capital gains is something to definitely consider. Depending on the structure of your business as well. If you have a family trust or an operating company and a holding company, there's ways that you can structure your setup to make this far more advantageous currently if you're starting a business or if pre-sale, etc. So, my advice would be to speak with an accountant or tax lawyer as soon as you could. If you think you're intending to start a business, if you have one and you're going to sell it, to take full advantage of what's available in the capital gains amount, which is about, in the next few years, it'll probably be around $1 million a person. So
I think it's about 915 right now is where it's sitting at, and kind of bumping up each year. But at that point, the first thing I usually tell clients if we're getting into tax structuring is talk to your tax accountant or specialist. We probably both know enough to be a little bit dangerous, Nick, or at least point in the right direction.
You got it.
Everybody's tax planning comes so much down to your personal situation and how you're structured. So you never want to mislead clients. Best that they talk to the professionals who do that best.
So sometimes there's situations where a business would sell and you don't get all the money up front as the seller. And clearly as the purchaser, like you had mentioned before, can we cash flow it to some degree? So I think the term is vendor take back and or like a promissory note. So do you want to riff on those a little bit as what those actually are and how they can be involved in the structure of a deal?
Yeah, so a vendor take back, VTB, or sometimes it's called a vendor holdback, but it's essentially, it's what you said, Nick, they're a promissory note. And we see VTBs on transactions more often than not. Very, very common. What it basically is owners helping outgoing owners, so the seller helping with financing. So if we run through a hypothetical transaction, that if you're buying a business for $1 million and you go to the bank and you say, I want a loan on this business, and they say, great, we'll look at it, we'll give you $600,000 in debt. So you have a $400,000 debt or a gap that you have to fill. Well, I say I can only come up with $200,000, so that brings us to $800,000. But we still have a $200,000 gap we have to finance. So what's very common, and banks like to see this as well to have some past owner involvement, is the owner will say, well, I'll hold a promissory note for the remaining $200,000. It's called a vendor take back. You pay me $800,000 up front, 80% of the purchase price, and I'll hold back the remaining 20% in the form of a promissory note. So you owe me, and we structure some terms around that. So you're essentially a secondary lender after the bank, who's the primary lender. And the terms of what that looks like can really vary. It could be a 1 year note. It's just, pay me a year later. It could be, what's very common I find is that it's not 1 year, because that can be very risky for a new owner coming in and knowing that they have a big payment, 1 year later. So oftentimes it's more like a 3, 4, 5 year note. So it's not it's very rare that it's as long term as it's not a 20-year loan. The owner, if they're 65, they're probably not going to be still wanting to help with that financing when they're 85. But, around 5 years is quite common. And then payment terms can vary and be negotiated. For example, it could be structured like regular debt where you get monthly interest and principal payments. It could also be structured in the way that you get interest only payments with balloon payments for principal after such a period of time. Oftentimes it carries some interest rate to understandably compensate the owner for helping with that financing. I mean, if you're going to go to the bank and get some financing, they're not doing it for 0%, and inflation's rising, so there's usually some interest rate worked out that's commensurate with the level of risk that somebody's taking on for that loan. So that's more or less how a vendor take-back's structured. It's very common, like I said, to see the owner have to hold some piece. Often not, it's not that common in our world to ask for it. The owner's going to help you finance 50% of the business. It might happen, but it's more common that you see a 10% VTB or 20% even VTB, kind of in that range.
So it's going to reduce costs potentially for that buyer. Also, I think one way I've seen it help is if the buyer's concerned about those key clients dropping off or something like that, it can kind of help take into consideration a decrease in the value of the cash flow on the business a year or two after, something like that. So, hey, I'll give you X multiple, but if so-and-so leaves, then, I'm not going to, and I just won't pay back, whatever else is owing. That happens frequently in my industry. Again, not sure how many others, but we're a non-tangible asset, completely Goodwill, really, industry in which, to purchase a business in our world can be relatively risky. So we want to mitigate it as a buyer as much as we can.
Yeah. And there's, aside from a VTB, there's different types of holdbacks or owner involvement that they'll be asked to do at closing. So, we would of course explain what all those mean during a process if they're part of an offer. But, business owners should know the difference between if they're being asked for a vendor holdback versus rolled equity versus an escrow holdback, for example, or something that's more common is an earn-out where you're actually earning a part of the sales price by hitting targets after a sale, which is very different from a vendor take-back. So, there's a few different things, and if any of those, you might be familiar with those, Nathan and Nick, but if you have any questions around any of those items, I'm happy to elaborate. But there's lots of different ways, I guess, is the key message of how deals can be structured. Yeah,
for sure. Well, I think there's definitely a lot to carry on there, and maybe we'll say to our listeners, if you have questions further from what hasn't been said, then definitely reach out to Jeff. Jeff, I'm just curious, is there anything else? Yeah, you got it. Is there anything else that you wish business owners on the buying or selling side of the fence knew now, entering into a sale or just in the current economy? What would you hope that your potential clients would think right now?
Yeah, I think the first thing that comes to mind, Nick, on that is it's going to take time. That I think that some business owners have come into it a bit blind into how much goes into the process. So a question I'm asked all the time is, how long is it going to take me to sell my business? And it's unfortunately one of those it depends answers, but oftentimes, if I'm to average it out, it's about a year from the time you sort of go say, yeah, I'm going to go to market. We take a business to market, we find the right buyer, we negotiate the right offer, we go through due diligence, you close it. If everything runs smooth, you might do it within a year, but it's oftentimes, about a year and sometimes longer because you may not find the right buyer or you go down the road with a deal and it falls through. So you just have to go in with expectations that it's going to take some time. It might be a bit of a bumpy road. It's due diligence I mentioned earlier that it can be a bit painful and somebody's coming in and business owners can get uncomfortable with that they're looking at all the ins and outs of your business and all the warts and, everything that happened over the years. And, business owners most business owners will probably take offense at different parts throughout the transaction because they it's their baby. They built this up. They grew this business, and now somebody's coming in and point out all the flaws in your baby and why your baby might not be as attractive as you thought it was. Like, it could be, it's a tough process. So our role is, sometimes we joke, like we're more of counselors sometimes than financial advisors in the business, that we just have to, reassure business owners and work with them. And it can be very, very emotional process. So the more, in addition to, it takes time and be prepared for some of that ugly, is my advice to the business sellers would be, or business owners would be, the better prepared you can be going into it, the smoother it's going to be. So if you have the luxury of being, a few years away from selling, then don't be afraid to, start talking to some advisors now about making sure you're properly structured for tax reasons, getting an assessment done on your business so you start to understand where some of the perceived risks might be, where you might be weak. So you might think you have a great business, but if your business is Nick's Carpentry and Nick is the face of the business and Nick's on every commercial and, Nick's the master tradesman and a buyer comes in and Nick's leaving, like what does that do to the business? And there's a lot of risk with the owner involvement there. So starting to understand through the lens of a buyer early on how they might view your business so you can start to work on those things and get ready for sale, can make a massive difference on your valuation.
Awesome. Perfect. Well, listen, Jeff, I think we're grateful for your time. We don't want to have to take any more of it today, but for our guests listening or anyone in the near future, where can people find you?
Yeah, so you can, our website is confederationgroup.ca, or if you Google Atlantic Canada mergers and acquisitions firm, I hope we come up. I have to check that. If not, we have to do some of those SEO audits that I don't quite understand, but
yeah,
how you bounce up on the pages. But yeah, if you can Google my name, and my email and phone number are pretty accessible, and I'll always, this is, a plug for our own firm, but just generally, even if you're not using us and using somebody else, it's having that first conversation with a firm like ourselves to start exploring the topic can be very valuable. And we ourselves are a no pressure type organization that, after initial meetings, we're not going to be hounding you. We realize that these things can take time, and oftentimes we're talking to people 2, 3, 4, 5 years in advance of selling. So we know if you start early, there's more time to get you ready for sale and help you maximize your value when it does come time. So yeah, I'm here, and hopefully you can find me. If not, that's an issue that we have to look into.
Some of our listeners may wonder about the structure of your firm if they're not familiar. So what I mean by that is, is it like first call's a discovery call? And at what point do you engage in a consulting fee or whatever that may look like?
Yeah, great question. So first call is really that discovery on a no fee basis. So we're not sending bills by the hour for time or anything like that for those initial meetings. So it's just purely discovery. We don't get into an actual fee structure until we would enter into an engagement agreement to actually sell your business. So we would, those upfront conversations on discovery and even looking at your financials and giving an opinion on pricing, that's all the upfront work that we're happy to invest the time in as a firm, because ultimately we need to know that we're aligned with the business owner if we're going to go down this road with them. Our compensations at our firm is primarily tied to success. So, if we're not able to successfully sell your business, then we're not putting food on the table. So, all that upfront legwork is essentially an investment in our time until we reach the point of actually saying we're going to sign an engagement agreement to move this forward.
Got it. Awesome. Last question: Is there one thing in your role that you wish business owners would ask you more often?
Oh, that's a good question. I guess a number of things that come to mind. The one thing would be that I wish business owners would ask more often would be to give me an honest assessment of what I'm not doing right. Tell me where I'm ugly or where my business is ugly, where I need room. A lot of times they'll come and they're so used to talking to customers and employees and everything, so they're always showing the best of the best of their business, and that's important. We want to know what makes you unique and what makes you competitive and valuable and all that stuff. But we also need to uncover everything that's not, because that's going to give us better opportunity to help work on those things and help you improve those things. So, don't be afraid to ask us about and show us, what you're not doing so well, in addition to what you're doing well.
Yeah. You mentioned it's like
I guess, and we'll be honest with you.
It's like the free agent contract in professional sports. You're going to get roughed up a little bit by your current team, something like that. So, but be open to it, and it's just business, and that's how you get the best value out of it. So, Jeff, it's been great having you on the podcast. Thank you so much for joining us. Jeff is again a partner at Confederation M A, and you can find him on Google. Hopefully, if their SEO is working the way it should. I know it is, though. We really appreciate your time. Thanks so much for joining us. Episode 19 of The Interesting People We Meet. Have a great day.
Thanks a lot for having me, guys. Appreciate it.